Welcome, everyone. I'm Greg Schnell, the Canadian technician, here to host the Market Buzz. This show looks at weekly setups across the U.S. market. Using the tools available on StockCharts, we'll look for long time frame trades. Please subscribe to my articles and Twitter feed. And we've got ourselves a bit of a rocky start to today, but today's a pretty important one, and I want to cover that off explicitly. We're gonna spend a whole bunch of time talking about what we're looking for, and maybe we got that this morning. And so while I'm too busy to trade, we're going to be sitting here looking at my show. Perhaps we should talk about the inverted yield curve. There's always questions about that, so let's get into that a little bit. And then a bounce here would be a buyable dip. And basically, when you paint the news red, really red, and in this case, it's the, oh my goodness, we got a recession coming and blah, blah, blah. That's the kind of day that people sell into the down move. Institutional investors buy it up, and then we'll get all the way to the other end of the deal where you get the retail trader saying, I guess it's different this time, and the institution person is ready to hand the shares back. So we're going to try and look at the chart specifically on that. So let's go here. I want to start by this one with a little more optimism. So I'm at the cabin in Windermere, and life is pretty good, but this bird photobombed me right in the middle of my photo. Anyway, if for all of those who haven't been to Canada, summers are awesome here. It's nice dry heat, and roughly about 80 to 90 every day. So anyway, enough good news. Let's get over to the markets. What I want to talk about here specifically, let's just go into the 5-minute view. And what you see here is we're trying to hold this low. And this is a pretty important low. And the reason is, as I mentioned, this really bad news this morning that came out that we've had the 10-2 cross, and we'll get into the mechanics of that right away. But here's the setup on the S&P 500. First of all, we're below the 20-period moving average, and on the big picture, we're also below the 50. But what we want to see, what we saw yesterday, which didn't work very well for me, was we saw a tweet, and it literally popped the market, and then we did nothing, and we couldn't break through the prior high. So today, we're watching very closely to see if there's any sort of thrust that can get us back through that level. And if we can't, then I think my continued bearish stance would continue a little bit further. And the reason that we have that I think we're setting up this way is we have a lot of information that isn't bullish enough to push us forward, and we don't have any earnings coming out, any big, the S&P 500 basically reports in July and October, and we've finished July, so now we're waiting for October. So you can see this MACD wave here for the S&P, and it's just sitting flat at the 0 level. Now, if it breaks down here, obviously, this is how when the downtrends happen, right? We went from 3,000 to 2820 in a couple of days there. So we're watching to just see if this can stay positive. And so it rolled over yesterday. Then we got the one minute tweet or whatever, and then the market basically covered shorts and went sideways and no real action. Now we're watching to see if this breaks. But if we just look through the rest of the chart, so the NASDAQ is trying to hold the same thing. The Russell's already given it up. And now the Russell is looking more like the lows from a week ago, trying to hold those. So that's a pretty important place. The Toronto Stock Exchange, you can just see how it got up to this line and just can't get through it, and it's starting to break down. Natural gas is an interesting chart. It's sitting at around $2, and which is really, really low. And so I'm watching natural gas to play that to the long side. Here's USO, and we briefly shot above the line yesterday, and we're back below it. Gold continues to hover up here. You can see we haven't done anything in the price of gold for a week, but the gold miners have been okay. TLT, we broke out to higher highs today, and again, that's the bond ETF, and then UUP is starting to move to the upside. So lots of things to consider. And when we work through these charts, this is the 5-minute of the S&P going right now, and I've got a parabolic SAR on here. It hasn't been hit yet, but this is really short-term stuff and not really. I don't trade with a parabolic stop and reverse chart. and I don't trade 5 minute. I don't trade even 60 minute. Most of my trades are big, long time frame trades. So, so we've got this backdrop, and the backdrop is that, well, if we just go to the advanced decline line data, you can see that the market, well, it hasn't broken down. The advanced decline line data continues to break down. And if we go to the high-low data, we're below zero, we're at minus 100, and yesterday's bounce couldn't get us back up above. And so that's why, sometimes it is just that a short covering rally basically forces anybody, a real short-term trader, to get stopped out, but it didn't seem like any new buyers showed up in the afternoon. So here's the New York advanced decline line. And again, we broke this trend line right around the end of the month. And so it was a pretty good signal, I think. I think we'd all agree that was a nice place to exit. And then this is coming down, and we've got this one more slope here, and we'll just see. And looking over here, you can see that this break in the September, August time or October time frame was a more gradual slope as well. So let's just see if this holds and bounce out of here. But um, we are we are definitely prying on the low end of the range. For the Dow Jones high-low index on the New York Stock Exchange, what we see here is just below zero. And again, the real question is, do we have the power to thrust above these prior highs? And so far we haven't. We tried here, but again, the NASDAQ wasn't participating, and now all of a sudden we're trying to hold these lows. If this starts to break to lower lows, I think you get something more like we saw in 2015, where the bleeding continues. Looking at the 1500, so S&P 1500, that includes the S&P 500 and some small caps and mid caps. What we're looking for here is just to see what the broad market is doing. And again, the big companies aren't going to sell first. The institutions like to hold that stable stuff. They might trade in and out a little bit, but for the most part, they're core holdings. Anyway, you can see that we clearly haven't broken down on the 1500 as much as we have on the broader indexes. So like on the NASDAQ composite or the New York composite. So this is trying to hold in, and that's the large caps basically holding this piece together. I will say that if we break through this 660 level on this chart, so you can see that it was resistance here, it was briefly support in here for about a month, and then it rolled over, briefly support in here for about a month, briefly support in here, and we're holding it so far. And I think if we start to head down here, this would be where the problem happens. So again, we're watching this 5-minute chart to see, can it hold? Does it have new buyers that show up? And it's on the back of this major negative news of um, the inverted yield curve. And so let's get into what the inverted yield curve really means. And again, this is a picture of the yield curve going back to 2000, but maybe I should just add a few extra days on here. What we want to talk about is that when the yield curve is in normal sort order, we have blue at the bottom, then red, green, and this is literally 1, 2, 3, 5, 10, and 30-year bond prices. And they have a normal stack. And then what happens is when we invert, you can see here that normally blue is at the bottom. Well, blue is kind of 3 or 4 up here. And in the zoom panel, this brown line is the 10-year. And what we see on the 10-year is that the actual ticker symbol fell below the red line in overnight. So the overnight was the 2-year, and the brown line is the 10-year. Let's not make too much of that, but one of the things that everybody talks about is, the economy typically doesn't go into recession for another 2 years. That might be true, but what happens is the stock market prices that in long before it ever happens. And we started falling, these yields started to fall in the middle of 2007 and fell all the way into early 2009. And by early 2009, late 2008, this thing had totally sorted itself out again. And we all know that the stock market bottomed in March of 2009 and then went on this huge rally, and you could see everything was fine. Well, now we have this compression that we've seen at the last major tops. Now, some people will point back here to the 2005, 2000, or 1995 to 2000 period. And one of the interesting things in there, you can see that this all got very compressed. We also had the hyperbolic growth of the internet coming on stream. We had companies worth, huge amounts of money, uh, and they didn't have a product yet. So we had some pretty interesting times, and I think we've always got a share of those in the market. But at that time, we had like hundreds and thousands of these companies, at least hundreds of them, that were publicly trading on the stock market and really had nothing. It was a dream and an idea. So let's go raise money and see if it'll work. On the big picture here, you can see that the S&P 500 broke its trend line a while ago if we use the 2000 low, the 2009 low. But if we ran a more shallow line, we can do that. And that would take, it basically came right down to our December low. So that's holding up so far. But you can see on the German stock market that this is already broken. And on the Japanese stock market, it's already broken. Now, if you look back in 2007, they actually timed the breakdown pretty closely. In 2000, the Japanese and German stock markets both had negative slope on them, while the S&P 500, so the Nasdaq, had broken in March. But the S&P 500 came back to test that March high all through the summer and into September. So with that divergence, it was one of the important clues that we had out there that things weren't good the rest of the world. And so now we've been going lower for the Nikkei for over a year, and we're about 20% off the highs, and yet we still haven't been able to break out. And you can see that price action actually overnight, it was crazy. The Asian stock markets were up marginally, like 0.2% or something. But then you looked at Europe and it was down like 1.9%, and it had just literally gotten hammered. So if we look at, here's the EWJ, and it's trying to hold these lows from February, June, etc. But you'll remember that the S&P 500 is way up here in the top right hand corner and has made a nice higher high, right? So the S&P's pushing way up, and then we go back and look at these ETFs that represent Japan, and they're gapping lower and they're having trouble, and they're really trying to hold this support level. So obviously the next couple of days will be important for that. And if we look at Germany, this one just broke below this 26 level, and now now we're lining up more towards the December lows. So we have this situation where these yield curves are starting to apply pressure to the rest of the world, and yet the American market has held up quite well. So from that, I just want to go through some of these yield charts, and I've just got some different views pointed out here. But this is a picture of the spread, and this is what everybody's talking about for the inversion of the 10-year minus the 2-year. And so if the 10-year had a 2% interest rate and the 2-year had a 0.5% interest rate, that spread would be 1.5. Well, now actually the 2-year has a higher interest rate than the 10-year, and so that's why we call it an inversion. So this short-term bond has a higher yield than a long-term bond. So looking back on the chart here was 1990, 1991, and on this breakdown, that was a big deal. In 2000, we saw the same thing where it actually reverted in 1998. We didn't get a recession then. 2 years later, we got the big pullback in high flying tech stocks, and it took a while for the stock market to roll over. Here, I've used the New York Composite just to be different. In 2007, you can see roughly middle of 2007, we had been inverted for a whole year, and then things started to fall apart. So everybody's assuming that we have that much time here. My main perspective is, let's watch what the charts are doing, but the rest of the world is already breaking down. And I think the American market has held up better, mostly on the back of these good tech stocks. So one of the big clues we have when we use stock charts is we can post a whole bunch of different types of pictures. And one of the things I think is important in this particular case is that we've done the minus sign between the two ticker symbols. And so with that, we can create a unique chart that shows this up, and typically people would have done that on on a very expensive $2,000 a month terminal. But with StockCharts, you're able to do a lot of that. I do want to let you know that there's a weekend show coming up this weekend with Chip Anderson, president of StockCharts, and he's going to call it All Aboard StockCharts, and it's at 1 p.m. Eastern time. And he's going to get into just some of the unique things you can do on StockCharts. So I would encourage you to go check that out. And we've also, just as a reminder, if you're new to StockCharts or if you're trying to learn StockCharts, I was a co-author of a book called Stock Charts for Dummies out of the For Dummies series, and it explains a lot of stuff about how to do settings and all of this information down on the lower part of the chart panel and how to use it. And again, one thing to remember that whenever you touch all this stuff, there's nothing permanent about it. You don't have to worry as long as you don't save it as a chart style. So feel free to turn on and off, like what does this y-axis label do? And when you push that button, you'll find out that it puts a label. Well, maybe I didn't push the button. Y-axis label, there it is. It's over here on the far right hand side, down in the corner. I was looking for it up in the middle. Down in this bottom corner, and this little label is the y-axis label. Anyway, feel free to go play with that. Lots of information there. And if you get a chance, that Stock Charts for Dummies book will help you find that stuff. Okay, looking in on this 2-year spread. So you can see, the last couple of days hasn't been too sweet for the spread, and all of a sudden things fell apart. And so this is why the stock market is getting worried. I would suggest to you that some of the other stock market topping clues have been when the 10-year makes a new 52-week low. We already passed that. When the 3-month makes a new 52-week low, we already passed that. So some of the other clues that regular technicians might look at rather than this spread or the yield curve or whatever, we've already passed that. So who knows if we're living on borrowed time or if we've got another 2 years. But I would suggest that the bond market is definitely signaling something is wrong. Now, this is zoomed in from 2018, and you can see literally market went up here. And remember that September, October timeframe, that's when all of the bond yields topped. And then we've been coming down since then. And obviously on the S&P, we've made a higher high, but on the New York Composite, we haven't been able to do that. So anyway, these are headed down. The brown line crossed the red line, which is the kind of the ceremonial or what everybody's talking about now. The 3-month has gone, in this case, the 1 year has gone below the 10-year a while ago. That was early July. And so when things get screwed up in that sort order, that's the problem. When they actually get started to straighten out, you'll see the stock market decline a little faster. And then on top of that, what we should see is after a while, they'll actually start to have normalized nicely before the stock market actually turns up. So when they normalize, the stock market's still continuing down, and when the stock market actually bottoms, things will improve before the bond market will have signaled normality long before the stock market makes its bottom. Anyway, okay, let's get into, here's the 30-year minus the 10-year. And one of the things I've been watching is this trend line break. And again, we're watching for this breakout. That's important. More importantly now, this is a really interesting line. What you see here, notice back in July of 2016, the yield curve normalized and the stock markets all kind of bottomed then and took off. So here we have this trend line on the yield curve or on this spread. And as this breaks down, I'm interested to see if we get another rally in here. Now, my data says no. Let's go back and just see how fast the stock market's moving. It's not. It's still trying to hold these lows. We'll see if this ends up breaking down. And the reason that I want to watch for this quite importantly is that negative news cycle. Again, my data points that we're going quite a bit lower here on the equity markets. And so I'm watching to see how the bond market responds. But what I would actually expect to start to see is this bounce off here and start to head higher. And as the bond yields normalize, then we're going to start to see the change come in to the equity markets where we go lower. Now, obviously, I don't want to cheer a lower equity market price. It's a lot easier to make money going up than down. But for the big picture on here, you can just see when these broke out to the upside that was not a bad place to be watching. And here was one signal back in 1995 where it broke out. but the stock markets, um, the S&P 500 just keeps soaring higher. The Nikkei in the German market pulled back a little bit, but uh, the S&P, it was literally a light switch back there and went on. But you can see in 1990, when this trend line broke, then that was kind of one of the areas where the stock markets all start faltered significantly more. So anyway, watching for that. Continuing to roll through these charts, this broker dealer chart I posted a couple of weeks ago in Don't Ignore This Chart, and it is breaking down here, and I think that's one of the things to be watching for. I have one chart I want to show you while I'm on that subject, just so I don't forget. But I put out an article, 19 banks losing uh, investor support, on the Don't Ignore This Chart uh, article list. And one of the things you'll see, this is the German Commerce Bank, and it made new 5-year lows. Okay, that's not that good. This is Deutsche Bank, and it's making 5-year lows. This is the European financial stock ETF. So broker dealers, asset managers, banks, etc. And you can see it's holding up better than those two charts up here. But quite frankly, for the last 18 months, it's been down and away. And we all remember this is when the stock market made its initial final high, so call it January, and then we pulled back, and then we got to the September top, and then we pulled back hard, and now we've tried to rally up, and we briefly got above it, and it's a failed breakout so far. But in the meantime, these banks have been wandering lower, and as we sit here today, and we could click on this chart for an update, actually, let me just click on it. And why can't I see that? I made a mistake or something. Anyway, apparently I've done something wrong. But normally you can click on the chart and it'll take you to a live picture of the stock. Here's the big picture for this ETF. And what I want to show you is back in 2012, 2016, 2018, we're trying to hold this trend line, and that makes it pretty important. So these are all the stocks that are very close of the uh, global banking um, system. And I didn't go hunting for 52-week lows or 5-year lows. I literally had a chart list and I went through it. And as I went through it, I found a whole bunch of stocks that are starting to break down. But this chart here is quite important. So up at the top is the US banking index, and you can see there's still some gap away from the line. The asset managers have already broken. So Franklin Templeton, which is ticker symbol BEN, a few weeks ago it was at a 52-week high. It's already very close to a 5-year low. So really quick movement on stuff like that. And we're starting to see this asset manager class. It broke the trend line, but hasn't been able to get going again. And here's the European financials. So as the Fed meets, and it's the Kansas City Fed who hosts the World Economic Policy Forum in Jackson Hole, and that's next week on August 22nd to 24th. It would not surprise me that something like this is displayed quite highly or prominently for that group, because you can see when these uptrends broke in these financial indexes, it was an important place on the chart. And even when quantitative easing ended in 2015, this was a chart that broke. 2018, the chart broke, and now we've got this major uptrend we're trying to hold. So all of these are bundled together to kind of say, a bit of a problem out here, and I'm pretty sure that they'll be looking hard at that kind of data to see what they can do from here forward. Anyway, I've covered off most of the charts in here regarding the bond market. Um, Obviously, on my weekend review, I have a whole bunch of stocks, a whole bunch of coverage of the bond market. So I'd encourage you to look at that. Let's go back and just look. So the S&P did not hold the lows and is now breaking down here. So to me, until we start to get some sort of a reversal where it holds, and this was an interesting place to look, but it was this candle without price action beside it that was concerning. And getting through the prior high, we tried and failed, and now we're having trouble holding this low. So if we could reverse off of here and head back up, this is a pretty meaningful place to to be watching for a low. All that to say, I'm still not that optimistic because all of my other data suggests we go lower. And so just keep it in mind here. We perhaps we can hold up, but lots of these charts are breaking, and I think our next leg here is the Russell needs to hold roughly 1470, and if it can't hold that, we probably have a bigger problem showing up for work. So as the stock market rolls forward, again, we don't know where the bottom is. I do want to sorry for the scrolling. I do want to show you one thing just zoomed out on this chart. So again, with the Pro account, you can have up to 10 price panels. So I've set all of these panels up here, and you can see this VIX. This is trying to explode higher. I think we'd all agree with that. Here was the uptrend on the 60-minute chart. Oh, it's so obvious when it breaks. Then a rebound back test fell apart. And now we're kind of jogging sideways. And we did the same thing back in September, October. We made the top. October was pretty jagged, lots of indecision. And then in November, December, we started to break down a bit more. But just look at the MACD on the 60-minute chart. We're really having trouble getting any sort of elevation up above this, I'll call it 10 level. And as we struggle here, this is just a good clue. When your momentum indicator is negative, it's a pretty hard place to be long the market. NASDAQ composite, we've broken and we've stayed below this. And this blue line is the 100-period moving average on a 60-minute chart or a 1-hour chart. But more importantly, roughly translated to a 20-day moving average. And in a down market, a lot of times you'll stay below the 20-day. You might get up to the 50-day, but it's somewhere in that range. Anyway, we've looks like on the NASDAQ composite, we're having trouble holding this trend line here. So that might suggest we're breaking lower. And obviously the Russell, we've broken the upslope, but now we're looking for horizontal support. TSX has been weakening for roughly a week before the US market. And now we're sitting here wobbling. And, this doesn't look like it's holding in very well. Again, natural gas, it can be a trade that goes counter trend. So I'd be watching that one closely because it's down at like $2 gigajoule. And when we break out from there, a lot of times this can go all the way back up to $4, and it can trade totally independent of the S&P 500. So that's worth watching. There might be some ideas for trades there. US oil price, you could just see this is the ETF tracking price of oil. But what have we got here? We have a low, a higher high, a lower low, a lower high, a lower low, a lower high so far. So to me, it looks like we're in a downtrend. And as long as that continues to hold, I think oil gives us a pretty good economic indicator of rest of world stuff. So not a lot of roses out there. Again, I started off with that nice picture just to kind of soften the mood this morning of my bearish tilt. Now, I did write an article on the weekend in the Canadian Technician explaining that I spent a lot of time trying to find lows and highs in the market. And yesterday when we saw that big rally, it was like, hey, maybe we're actually going to get one here. And of course, we had something pretty significant happen where there was some significant change in trade policy announced. But as we work forward here, one of my big concerns is the Japanese stock market. I mentioned it many, many times. So continue to watch overseas. I think they have some problems that'll have to get dealt with, and unless we get a shocking announcement out of there, we're probably got a lot of world pressure in front of us. Thanks for taking the time to join me on Market Buzz. Market Buzz airs live on Wednesdays and Fridays at 10:30 a.m. Eastern, 7:30 a.m. Pacific time on StockCharts TV. You can also catch replays on the StockCharts YouTube channel or on StockCharts TV, which has a running list of technical charting informational shows. Don't forget about chip shows, all aboard StockCharts at 1 p.m. Eastern. Thanks. Bye-bye.